Can an entity be profitable and not liquid? Yes. How? Not all revenue. Translated to cash received, and not all expense. Incurred translated to cash paid. A foundation has been laid in the previous episode on cash and accrual basis. In this episode we will be giving further explanation on liquidity and profitability with substantiating examples. Don't forget to hit the like and subscribe button.
Welcome to Investment Knowledge Hub. In this episode, we'll be looking at the relationship between liquidity and profitability. We're answering three major questions. Number one, can an entity be liquid and profitable? Question two, can an entity be liquid and not profitable? And question number three, can an entity be profitable and not liquid? But before answering these three questions, we'll be looking at cash and accrual basis. After discussing cash and accrual basis, we'll be dividing the two concepts, liquidity and profitability. And after looking at that, we will look at the differences between liquidity and profitability. And after looking at these three major points, that will now lay the foundation for the response to these three questions I mentioned earlier. First, cash and accrual basis. I said that cash and accrual basis are the foundation upon which the concept of liquidity and profitability are based on. What does this mean? Without cash and accrual basis, there will be nothing like profitability and liquidity. Now, what is cash basis? Cash basis recognizes revenue and expense when cash is received and when cash is paid. What does this mean? This means that when the transaction happens, cash basis only recognizes the transaction only because this transaction when cash is received and when cash is paid for such transaction. Say for example, Omolara bought 3 bags of rice from Graceman Foods, 20,000 naira, and paid cash. For such transaction, because cash is received by Graceman and cash is paid by Omolara, cash basis will recognize such transaction. On the opposite, Omolara bought 3 bags of rice from Graceman, 150,000 naira on credit. In such situation, such transaction will not be recorded under cash basis because in such transaction, cash is either received or what? Nor paid. Now we go to accrual basis. Accrual basis recognizes income at the time revenue is earned and expenses when liabilities are incurred, regardless of when cash is received or paid. So accrual basis is the opposite of cash basis, meaning that under accrual basis, cash is either received or paid. So because cash is either received or paid, accrual basis recognizes income when revenue is earned, not necessarily when such revenue, cash comes in for such revenue, and expense as liability, not necessarily when cash is paid for such transaction. Now we move to the definition of the two concepts of profitability, the two concepts, profitability and liquidity. When we talk about profitability, we are talking about how profitable a business is. And when we look at how profitable a business is, two major concepts come to mind: revenue and cost. We want to know how profitable a company is or an entity is. We look at how much revenue the company has made and how much cost the company has incurred. In other words, we look at how the company has been able to maximize its revenue and how the company has been able to minimize its cost. So the ability of an entity to maximize its revenue and minimize its cost determines how profitable the company is. And that's when we talk about what? Profitability. And also when we talk about profitability, another concept of profitability is how is the bottom line doing. So when we talk about bottom line, we are saying that the revenue has been recognized, the cost, both direct and indirect costs have been subtracted, and we now have the bottom line, which is the profitability. And when we talk about profitability, we are talking about how the company is doing in terms of profit, in terms of returns to the shareholders. Having discussed profitability, we talk about liquidity. Liquidity refers to the ability of an entity to meet a short-term liability. Just as we said earlier, explaining cash basis and accrual basis, a company can be profitable and may be profitable and may not be liquid. So we are saying that liquidity talks about the ability of an entity to meet its short-term liability. And when we talk about liability, we are talking about the obligation of the business to the outsiders. What the business is owing the outsiders. Having discussed that, we go to the differences between profitability and liquidity. One, profitability is an income statement item. What does this mean? Income statement item in the sense that we arrive at profit. We know how profitable a company is from the income statement of profit or loss and growth and other comprehensive income. So, how do we know that a company is profitable? We know that after the preparation of the income statement. For liquidity, liquidity is a statement of financial position item. What does this mean? For us to know how liquid an entity is, we look at the statement of financial position. That is where we have the assets and the liability. Knowing fully well that to know how liquid the company is always the difference between the current asset and the current liability of an entity. Recall that we define liquidity as the ability of an entity to meet their current liability, meaning that these are current assets, these are current liability. So the difference between the current liability and the current asset tells us that at any point in time, the company can always settle its current liability. Also, profitability is for a period. What does this mean? Profitability is for a period because it shows the report of a company for a particular period. While liquidity is per time, it is not period based. It changes, it fluctuates. It is a function of what the current asset is at a particular time and what the current liability is at a particular time. Let's also go to the third one. It is more important in the long term of the business. A business will not be profitable, and it doesn't mean the business will not be profitable in the long term. But for liquidity is more important in the short term. Why? Because the moment a company or an entity cannot meet a short-term liability, it simply means the company is insolvent. The company cannot meet its current liability. It simply means that the going concern of the business is threatened. Because if the company cannot meet its current liability, it simply means that the existence of the business is threatened and is questionable. Number 4, it is a measure of financial performance. Profitability measures the financial performance of an entity. How will the company perform? And when we talk about financial performance, we are talking about statement of profit or loss and other components or income statement as the case may be. We are talking about the bottom line. How is the company performing? Financial performance. While liquidity talks about financial position, what is the financial position asset? And we're talking about financial performance, a little recap. Financial performance is for the period, while financial position is asset. And this buttresses the point we made earlier that profitability is for a period, while this is for a particular time, asset a particular time. Meaning that after that time, things are bound to change. Going to the first question, can an entity be liquid and profitable? The answer is yes. How can an entity be profitable and liquid? When is a company profitable and liquid? 1, when the business is optimal in the utilization of its resources. What does this mean? The company is optimal in the utilization of the resources. The company has cash and the company is able to invest the cash into the business to make revenue. This will mean that the company is putting so much into inventory to what it is buying, and what it is buying is being translated into revenue, and the same revenue is being translated into cash. In that kind of situation, the company has liquid, and the liquid is being invested into the business, and as the liquid is being invested into the business in the form of inventory and other investments, the company is generating revenue, and the revenue is being generated into cash. So, meaning that the company is striking a balance between the liquid position and also striking a balance between the profitable position. This will mean that the bottom line is positive. Also, the current assets exceed the company's current liability. That is what that means. 2, the company is able to convert its sales to cash. It is important to note that the fact that a company makes so much revenue doesn't mean the company is liquid. Why are we saying this? We are saying this because under accrual basis, income is recognized, when revenue is earned, not necessarily when cash is received. That will mean that when goods are sold, when inventories are sold, it doesn't necessarily mean cash is received for those goods that are sold. So inability of a company, of an entity, to collect cash for every of its inventory will mean that the company is not liquid. But if the company can sell and get cash for all the sales, that means the company is what? Is liquid. And of course, if the company is making so much revenue, that means the company is profitable, and the revenue is converted into cash. That would also mean that what, the company is also liquid. And on that note, we can say that the company is what, is striking a balance between the liquidity and the profitability. How? The company is making sales, sales is increasing, which possibly affect the bottom line, and the sales, they are not credit sales, they are cash sales. So cash is also coming in to what, to increase the current liability, current assets, which when subtracted, when used to subtract the current liability, it also tells us that the company is what, is liquid. Going to the third point, the entity is able to strike a balance between revenue maximization and cost minimization. What does this mean? When a company is maximizing its revenue, the company bottom line is increased. And do note that cost minimization would affect the liability, which will eventually what, affect the liquid position. If the cost is minimized, that will mean that what, the liability will be what, will be reduced to the barest minimum. Going back to what, the accrual concept, that tells us that what, accrual concept recognizes income when revenue is earned and expense as a what, as a liability. Meaning that if cost is reduced to the barest minimum, liability will also be what, reduced to the barest minimum. If revenue is maximized, bottom line profit will also be what, will also be on the increase, which will mean that in that kind of situation, the company is what, is profitable and liquid. Going to the second question, can an entity be profitable and not liquid? The answer is still yes. How can an entity be profitable and not liquid? Why would the company be profitable and not liquid? One, when the company makes so much sales and is unable to convert the same sales to cash, just as I said earlier, the company is making so much. By making so much, it simply means that what, the company is what, maximizing its what, its revenue. But all the revenue, they are all on credit. Having the revenue on credit would mean that it doesn't translate to cash. And if it doesn't translate to cash, that would mean that the company is not what, liquid. That's what that means simply. Two, if the company invests in big machinery, a company can be profitable and not what, and not be liquid, in the sense that the liquid cash the company has invested in what, in big machinery. And machinery is what, is a non-current asset, which eventually will be used to generate revenue. But the moment the big machinery is purchased, it doesn't translate to what, to revenue as at that particular time, but may in the long run. But at the moment, it has landed the company in what we call cash trap, and that will definitely affect the what, the liquidity of the entity. So in this case, a company can be what, can be profitable. All the profit it has made, once it is invested in big machinery, it will affect this aspect of the statement of financial position. And affecting this aspect of financial position will mean that this aspect, current liability, will eventually be what, greater than current asset. The third response to that, if the company is overtrading, overtrading simply means a company is biting more than it can chew. If a company is biting more than it can chew, it can also lead the company to cash trap, which is an item under current asset. So the company can be profitable, but it will affect the liquidity of the same company. Going to the third question, can an entity be liquid and not profitable? The answer is still yes. How can an entity be liquid and not profitable? A startup can be liquid and not profitable. A startup has so much funds injected into the business for the business to pick up and strike. But we all know that for a startup, the probability of a startup making profit at the beginning of the business is almost zero. So a startup will always be liquid because the funds invested by the shareholders, owners of capital, shareholders, and all angel investors, venture capital, and all. So a startup can always be what? Can be liquid and not profitable. Secondly, when can a company be liquid and not profitable? When a company takes a long-term loan for the business, when a company takes a long-term loan for the business, such business can be liquid and not profitable. Taking the loan is to expand the business, but the profit will not come immediately. So in that kind of situation, the company has so much liquid to play with, but the company is still unable or is still at the verge of converting the effort into affecting the bottom line and the financial performance of the entity. Second point, when a company takes a long-term loan for the business, the company can be liquid, but same company will not be profitable. Company took the loan for business expansion. So at that point, the company took the loan for business expansion. The company is liquid, but the bottom line of the business is yet to be affected by the expansion the company is taking. And as such company may be liquid and not be profitable. Third point, when the entity is under trading, everything is risk in business. Under trading simply means the company is scared of injecting so much into the business. And when the company is scared of injecting so much into the business, that would mean that the company doesn't have so much goods to sell. And of course, the company may be profitable, but such company may not be liquid. Because it is the investment of the company in inventory that the company eventually sells and the company generates revenue from. And if the revenue is not increasing, the bottom line will not be attractive, which means that the company will not be profitable. When each funds are invested in the business, the business will be liquid. And that is very, very explanatory. Investment of each one into the business will mean that the business has so much liquid to trade, invest in inventory, invest in research and development, and just so that the revenue of the business is maximized, but not in the immediate term. As we all know, that profitability is for a particular period where liquidity is at a particular time. So when these funds are invested in the business can be liquid and not be profitable. Availability of funds into the business means that the business is liquid but will not be profitable. Just so as to drive home my point, I decided to put up these two questions, though kind of funny. These two questions came from experience. Number one question: does a profit of 100 million mean the company has 100 million in the bank account? The answer is a no. Why is the answer a no? A conversation came up between a finance and a non-finance manager. The finance professional told the non-finance professional that, man, we did well in the last quarter. We made a profit of about 17 million. Wow. The non-finance professional was thrilled, amazed at the information. Only for the non-finance professional to ask, does that mean we have 76 million in our bank account? And the finance professional was very fast to tell the non-finance professional that no, it doesn't mean we have that exact amount in our bank account. And this explanation will help to answer this question in the mind of non-finance professional. Why is it that having a profit of 100 million does not translate to having 100 million in the bank account? Number one, we look at the concept of accrual basis. The question: does a profit of 100 million translate to having 100 million in the bank account? No. And this response will answer this concern in the mind of non-finance professional. To answer this question, we look at accrual basis. Accrual basis recognizes income when revenue is earned and expenses, and records expenses when liabilities are incurred. What does this mean? When revenue is earned, it doesn't necessarily mean that cash has been received. And when expenses are incurred, it does not necessarily mean that payment has been made or cash has been paid. What is this saying? This simply means that when revenue is earned, it will be recorded. It doesn't translate to cash. And we know that our bank account is a function of the cash that goes in and comes out. So if revenue is earned and it doesn't translate to cash, that would also mean that having so much in our bottom line doesn't translate to what? Having the same thing in our bank account. And spending so amount on credit, which doesn't translate to the money going out through the bank, also simply means that what? Our balance in the bank will not be the same, because revenue and doesn't translate to cash coming in. This not all revenue and translate to cash coming in. Also, not all expenses incurred translate to what? Cash going out. So let me give you this code to it. Not all revenue earned translates to cash coming in, and not all expenses incurred translates to cash going out. Also note that depreciation is a non-cash transaction which affects the profitability of an entity but doesn't affect bank. So just have to buttress this point. Not all revenue earned translates to cash. This simply means that a company can make 100 million in the revenue and just about 70% of it is received as cash. In that kind of situation, that would mean that only 70% will impact the bank account, and that would mean that 30% doesn't impact the bank account, whereas the same 30% account for the bottom line, account for the what? For how profitable the business is. And also, the same company can incur 50 million as cost. And this would also mean that just about 80% are paid, affect the bank account, while 20% account for liability. Just a little recap. If 70% here affect the bank, 30% will affect receivable. And as I said earlier, if 80% of the 50 million incurred as expenses affect bank, that will mean that our 20% will be what? Our pay. This will mean that the profit of a particular amount doesn't translate or doesn't mean that the business has that exact amount in the bank. I also gave an example of a contra debit or contra credit transaction. Depreciation is a non-cash transaction, a contra debit transaction. It is passed against the depreciation account and what an accumulated depreciation account. Also, provision for bad debt. Bad debt is also a non-cash transaction that is passed between bad debt and receivable account. Bad debt is a non-cash transaction. It doesn't affect bank, but it affects the bottom line. Depreciation is also a non-cash transaction that does what? That affects the profit of how profitable the company is, but doesn't translate to bank because cash is not paid to Anybody. Hope that is very clear. Can a company make so much profit and not have fund to pay dividend? Meaning it can and not have cash to pay dividend? Yes. If the chunk of the revenue that was made was not converted to cash, a company can make a revenue of 50 million and was able to convert just 20% of the 50 million to cash. This will mean that just about 10 million out of this 50 million hits the bank account, and same company can make 20 million profit, but that means that 40 million e got for the receivable. This will mean that the company can make a profit of 20 million, but this not even 15 million is traceable to the bank account, and dividend is not paid on receivable basis. When dividend is paid, it is paid by cash. The only option to this kind of entity is to declare bonus, which means an entry will have to be passed between the retained earnings of the company and the equity of the other share capital nominal of the entity. I hope the two concepts of liquidity and liability are very clear, starting from the accrual and the cash basis explanation to the definition of the two concepts, liquidity and profitability, to the differences between the two concepts, liquidity and profitability, and to the responses to the three questions I mentioned at the beginning of this exposition. Can a company be liquid and profitable? Can a company be liquid and not profitable? Can a company be profitable and not liquid? I hope all these responses you find them very, very useful. And these two questions I have here. Thank you so much for watching. Should you have any question, do not hesitate to type in the comment section. We're glad to have your comment and your critique. Thank you.